Okay, I've started the recording, so Dr. Boateng, over to you.
Thank you. Thank you, Caroline, and good afternoon to everybody. It's good to be with you once again. And this time we're looking at financial management, part 1. So you'll notice that my slides are very sunny and bright, and that's because I want to start right off by breaking the ice when it comes to financial management. There are lots of us who have phobias around it, and it shouldn't be so. Can we go on, Caroline? So what is financial management? The contents of the presentation is going to look at what financial management is, why it matters, and then debunking the myth about finance and accounting. And then we're going to look at the accounting basics. We're going to look at what is bookkeeping, accounting terminology, and some key financial statements. Then we'll look at some of the things that we can do with financial management skills, like financial management and decision-making, analytical tools we can use. We're also going to look at planning and how that comes into financial management and decision-making. Thank you, Caroline. So I'm hoping that you'll go away with these outcomes, understanding what the nature and purpose of financial management is, appreciating how it's important to you, the CEO, and having a basic understanding of accounting concepts, being exposed to the key financial statements and understanding how information that comes from these financial statements can assist you with better decision-making and overall management of your businesses. Thank you, Caroline. Right, so what is financial management? My bright, sunny section dividers. Financial management is not to be feared. It's bright, it's sunny. So financial management, it's the two words, finances and management. Finances refer to monetary resources, your money, and management is dealing with or controlling that money. So when we talk about financial management, we are talking about how to deal with and control our financial resources. Thanks, Caroline. Okay, so who practices financial management? It's basically everybody. Everybody at different levels, in different ways, practices some degree of financial management. We do it every day without thinking about it. Your petty trader on the side of the road selling oranges and groundnuts does it. A school pupil who has to balance their pocket money, decided they'll save, decided they'll buy a cheaper snack today, or blow it all, is practicing financial management. And then of course you have your investment professionals. So it's something that happens every day at different levels. Can we move on? Thank you, Caroline. So why does it matter? Why does financial management matter? Thank you, Caroline. Right, so financial management matters because finance is a limited resource. We don't have, invariably, most of us don't have all the money that we would like to have. We have some money and we have to be wise about it. So money is finance is a limited resource. Financial management also encourages discipline. For financial information to be of use to us, it has to be produced at the right time and it has to be produced accurately for it to be of value. If it comes at the wrong time, if it comes and it's all wrong, we can't really use it. So the discipline of producing the right things at the right time is important. I know that for most of you, you do bookkeeping on a daily basis. Maybe somebody else does it and you check it. That is part of that discipline I'm referring to. Again, we've often heard the statement, cash is king. Cash is very important in business. It helps us to be able to manage our businesses from day to day. And particularly in your industry, in the travel industry, there are a lot of you who basically have to pay for what your customers want from you. You basically have to pay for the tickets ahead of time, and then the customer pays you later on. So you need to have money on hand. And also, looking at COVID-19, at a pandemic, at uncertain times, the people who have money, the people who have cash, are the ones who are able to be flexible and adapt to the circumstances easily. If I take yourselves, for instance, travel has really changed. The trends in travel have changed. There may have been many of you who were focused on the international market, but now you're looking inwardly. You're looking at how to focus on the domestic market and how to create business out of the domestic market. You may be looking at new types of tours. You may be looking at marketing campaigns to target locals in Kenya, locals in Ghana. So basically, it's important to be able to have money to be able to do those things, because as wonderful as your ideas might be, if you don't have the money that you can allocate to making those changes, it's not going to happen. And generally, knowing financial management improves our businesses, their performance, and how we run them. Thank you, Caroline. Right, so what is the importance of financial management for you, the business owner? I've touched on it in the last slide. Ultimately, you, the CEO, the owner of the business, the buck stops with you. You are ultimately responsible for the stewardship of the financial resources of the business. You are responsible for looking after the financial resources and making sure that they are used wisely, that they are used for the right things. You are responsible for controlling and managing the financial resources. I know that a lot of us have an accountant and we rely on him, completely. And then we do a few little things on the side. But ultimately, you are in charge of the control and management. It helps us to plan ahead for the business, to be able to set goals and allocate resources. It also helps us to be able to come up with strategies for the business, because knowing what the financial information is, we then know what we can do and what we need to be doing and what we can put towards it in terms of the finances. Understanding the financial information also enables you to check the health of your business on an ongoing basis. From time to time, you can take certain data from the financial information, or you can apply certain tools to be able to check performance, to be able to check how sales are doing and so on. And generally, it helps improve your decision-making and makes your business more successful in meeting its objectives. Thank you, Caroline. Right, so I'd like to debunk the myth. I started off by saying that my slides are bright and sunny because I don't want us to go away thinking that this is a heavy subject and what are we going to do? So debunking the myth, if we can go ahead, Caroline. So basically, all I want to say here is that you can do it too. It's not something that is reserved for a select few. Yes, your accountant is a very special person who went to school for years to learn to do all those numbers, but you can do it too. So what I say to a lot of the women that I meet is the different tools that we use, they are there to serve us. We are not meant to be serving them. They are meant to serve us. So financial management is another thing that is supposed to serve you. So if you learn about it and you find out which bits you can use easily to bring out more value from the financial information, it will be serving you, and that's what we're looking for. You can know a few basics that you can apply again and again in very useful ways to add value to what you're doing. And at the end of the day, I'm saying we're learning about financial management, not because we want to fire the accountant, but because we can use it to get more value out of him and to make what we do as CEOs, as managers of our businesses, we can use it to take it to the next level. Thank you, Caroline. So we're going to look at a few basics of accounting. Thank you, Caroline. So bookkeeping. Bookkeeping is one of the main foundations of accounting. And I know that you all do bookkeeping. Bookkeeping is about recording all of your income and all of your expenditure frequently and regularly. Some people do it daily, some people do it weekly. I've been told that because of the nature of sales in your business, sometimes it makes more sense to do it weekly, but you do it regularly. And so why is bookkeeping important? It's important because it tracks the revenue that comes in, the sales that you make, and it tells you what the sale was for. Was it for tours? Was it for tickets? Was it for visas? And on which date? And you're also able to monitor the expenditure. What did you spend? What money went out? What was it for? And when was it? You're able to tell from the bookkeeping if you're making a profit or a loss. So every day that you make your entries, you know whether you made a profit that day or a loss. Knowing about your income and your expenditure, it makes it easier to plan. And so it's part of the basis of accounting discipline that I referred to earlier. And accurate accounting records assist you when you want to obtain external finance. So for instance, you want to go to the bank for a loan or an overdraft or whatever it might be. The bank wants to see your finances. And it all starts from accurate bookkeeping that feeds into the other finances that your business produces. Thank you, Caroline. So what are the key financial statements that I'm referring to? We're looking at our income statement, that is also called a profit and loss statement. We're looking at a balance sheet, and we're looking at a cash flow statement. There are other financial statements, but these are the key ones. An income statement, it shows the profit or loss for a particular period. And what that basically comes down to is how much did the business make in sales, less what the business spent, and that gives you your profit or your loss. If you spent more than you sold, then you're going to make a loss. If you sold more than you spent, you're going to make a profit. Your balance sheet shows what the business owns and what it owes at a specific point in time. So again, it lays it out on the balance sheet in terms of what the business owns, less what it owes, and that gives you the owner's equity, what belongs to the owner of the business or the shareholders of the business. Your cash flow statement, another important one. It shows you the actual cash that the business has at its disposal at a particular time. And it's calculated by looking at all your cash inflows, less all your cash outflows. And when we say cash inflows, we are talking about the money that is actually in the business, because it's possible to make a lot of sales, but if there were credit sales, the cash is only coming into the business at a later date. So the cash flow statement looks at the actual cash, the money that the business has now. So those are the three key financial statements that a lot of financial management can be built on. We can carry on, Caroline. Great. So here we have an income statement on the left. But more importantly, the terminology on the right. So your revenues are the sales that you're making, the money that is coming in from your sales. If you have money that is coming in from other sources, that is also revenue. So if you look at the income statement on the left, I hope you can see it, your revenues, it's talking about products or services. So for instance, your service one might be your tickets, service two might be your tours, service three might be car rentals, and then other revenues. So if there are other revenues that your business has, maybe you own a building and you rent out some of the offices. That would be in other revenue, for instance. And then your cost of goods sold. Your cost of goods sold is basically the direct expenditure on the services or the products that you sell. And then your gross profit is the difference between your revenues and your direct expenditure. So gross profit is your revenue less your direct expenses and tax. Operating expenses are the other expenses that are not directly related to the product or service that you sold, and they're all listed down here. Again, this is just an example of an income statement. So your specific income statements will look different because the items that you deal with are different. So the operating expenses are not directly related to the product or service, but they are the other expenses. Your operating profit is your profit before tax, and your net profit is all of your revenue less all of your expenses, including tax. Thank you, Caroline. So that was the income statement. If we move on to the balance sheet, the balance sheet is often referred to as a snapshot of the position, the cash position of the business at any given moment. And what the balance sheet shows you is what the business owns and what it owes, and what the owners also own. So the headings, the balance sheet is on the left. Your assets are what the business owns. Current assets, your cash, accounts receivable, they are assets that can be converted to cash within 12 months. So you have current assets and you have long-term assets. Current means convertible to cash within 12 months. Long-term means a longer time frame than 12 months. So there are those assets that you can't just easily convert to cash within 12 months. It could be land, it could be buildings, it could be fixed assets of different kinds. It's a bit more difficult to convert them into cash. Liabilities are what the business owns, what it owes to others. So for instance, your debts. And again, liabilities are also divided into current liabilities and long-term liabilities. Again, current means something that is happening within 12 months. Long-term means beyond 12 months. So your current liabilities are the debts that you need to pay within 12 months. And your long-term liabilities are the debts that are payable beyond 12 months. So if we look here, your current liabilities include your accounts payable, credit purchases from your suppliers. You're going to have to pay them within 12 months. And your taxes that are payable. You're going to have to pay Ghana Revenue Authority, Kenya Revenue Authority. You're going to have to pay them within 12 months. Your workers' salaries, you're going to have to pay them within 12 months. So all these are current liabilities. And then your long-term liabilities are debts that are payable beyond the 12-month time frame. In this example, there's a long-term loan. So maybe you got a loan that is payable over 5 years. That's a long-term loan. You're looking to pay it beyond 12 months. And then the owner's equity is what the business owner owns. So here it's paid in capital. The capital that was paid in to the business by the owner, yourselves, what you paid into your business at the start, and then retained earnings that you have kept back in the business. All of that is owner's equity. Thank you, Caroline. Okay, so the last one that we're going to look at is the cash flow statement. I mentioned that the cash flow looks at the actual money that the organization has at its disposal at a given time. It looks at all the inflows, cash inflows, and then it looks at all the outflows. It looks at where you spent money and where you earned money. For the purposes of the cash flow statement, money can come from your operations. It can come from all the things you do as a tour operator related to the business. It can also come from investing. If you've put some money into investments, the returns that you're getting from there, the cash that is coming from there is inflows. And then financing. If, for instance, you've made some loans, the payments, the repayments that are coming in, that's part of your cash inflows. And then your sales outflows. Your sales outflows, it's sales again, sorry, outflows again from your operations. Outflows, expenditure on things that relate to your business. So it may have been cash that you paid to tour operators. It may have been payments that you made for tickets that you need to buy beforehand for your customers. It could be money that you decided to go and put into an investment. It could be money that you loaned to somebody. So these are the different categories of expenditure that are possible. So it's looking at the cash inflows and balancing them out against the cash outflows. And the increase or the decrease for that period is what gives you your basically your net cash position. So if you balance out your inflows and your outflows, it lets you know how much cash your cash increased by during the period. If it's a loss, it lets you know how much your cash decreased by for the period. So to calculate the cash that I have at the end of the period for which I'm calculating it, I'm starting off by looking at the cash that I had on hand at the beginning of the period. All that means is that if I want to do my cash flow for this week, I'm going to look at the cash that was left over from last week, from the last day of business last week. How much cash did I have left over? So that is what I mean by cash on hand at the beginning of the period being this week. Now I'm going to take that cash that was from last week. That is going to be my opening balance. And then I'm going to take the increase or the decrease that I calculated. Difference between my inflows and outflows gave me my cash increase or decrease. I'm going to take that and add it to my beginning, the cash that I had from last week. And that gives me my total cash on hand at the end of the period. I hope that everybody understands this. It's a lot of words, but it's saying something very simple. How much cash came in this week? How much cash went out this week? What's the difference? That gives me my cash this week. But now I need to know the total cash that I have now. So I'm taking the cash that was left over last week and I'm adding it to the cash that I have this week. That gives me my total cash available now. And basically that's what a cash flow statement is. Thank you, Caroline. Okay, so now we're going to look at how we can assist our decision making with financial management. There are various ways in which we can make decisions with the help of financial management. And there are things called analytical tools. So we're going to have a look at some of them. Thank you, Caroline. Okay, so let's hold on to what we've done. We've looked at our basic financial statements. We've looked at our income statement. We've looked at our profit and loss statement. We have looked at our cash flow statement. So those are the key statements, the basic statements that we have. Now, in using financial management, there are processes that we can use to get additional value from those key financial statements. So analytical tools are different tools that include looking at trends. You can look at the trends across your financial statements over a number of years. You can also look at certain formulas that you can apply to your balance sheet, to your income statement to get additional value out of them. And then planning. There's planning that you can do as part of the financial management process. And all of this contributes to improving your decision-making in your business and improving how you manage your business and the performance of your business. So as a result of skills from financial management skills that you have, you'll be able to understand the financial implications of different things that are happening in the business. You'll be able to understand the financial implications better, which leads to better decision making. And as a result of financial management, you'll be able to use timely and accurate financial information that will improve the performance of your business. And then again, because of your financial management skills, you can get more value out of your accountant. It's like speaking with someone in a different language. You may know a few words of the language, so you can communicate to a limited extent. But when you learn the language more fully, the communication becomes richer and it becomes of more value. The things that you can get out of your accountant will be expanded by your knowledge of financial management, and he can produce more useful items for you beyond the standard reports and so on that he generates now. Thank you, Caroline. Great. So we've looked at how applying financial management can improve your decision-making, your business management, and your performance. We talked about analytical tools, we talked about trends, and we talked about formulas. So basically, these analytical tools, they help you to interpret the financial statements. Financial statements are lists of numbers that are put in front of you, and it can all be a blur. But when you know how to get value out of them, then they become really useful and interesting. So these tools help you to take that raw data from the financial information and convert it into useful information. Trend analysis. In trend analysis, you take a financial statement item and you compare it to that item over a number of years. So for instance, I could say, what have my gross profits looked like over the last 5 years? So I'm going to go back into the accounts and pick up just the gross profits and compare them. And I'll be able to see the direction they are heading in. You know, have they been going up? Have they been going down? And that in itself is information I can use, because if my gross profits are going down, then I know that something is wrong and I can think of something to do. That's the decision-making bit. If my sales are going down over a number of years, it was fine before, it was high, and it's gone down, down, lower, 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 there's a serious problem. But because I know trend analysis, I can pick it up, I can see the direction, and I can do something about it. Ratio analysis, another tool. It basically takes a formula and it applies it to financial statement items to measure how we are performing in a particular area. There are different types of ratios. There are ratios in liquidity, which basically is looking at your cash. There are ratios for efficiency, that is looking at how well certain things in the business are performing. There are ratios for gearing. All gearing means is debt. There are ratios for looking at how much debt is in your business. So in the example here, this is one of your most popular ratios. The current ratio measures liquidity. It's basically taking your current assets from your balance sheet and taking your current liabilities from your balance sheet. And what that's doing is to say, my current assets are the assets that I can turn into cash quickly within 12 months. My current liabilities are the amounts I owe within 12 months. So what this ratio tells you is, do I have enough assets to be able to pay my current liabilities comfortably? That is all that is telling you. Now, I'm going to look at a few of the ratios. And what I want you to know before I go there is that you don't need to know these. You don't need to know these by heart. You don't need to memorize them. You just need to know that they exist. You need to understand what they do and how they can be of value to you. Because anytime you want to use them, you can go and pick it up and apply it to your balance sheet, to your income statement. I call it your toolkit. This is something you go and add to your toolkit. And when you need it, you take it out and you use it. Thank you, Caroline. You can carry on. Right. So going into ratios, profitability ratios. Profitability, it's a key measure of your business success. You're making profits when your revenues are greater than your expenditure. It's important to know that you're making profits. So here are different examples of profitability ratios. Your gross profit percentage, it shows you your overall profitability and how well the business is producing the goods or the services and creating profit. Your net profit margin, it shows you whether the company is generating enough profit from sales and whether your operating costs and overheads are being controlled. Because you may be making a profit, but it's possible that you could make even more profit if you were keeping your costs in check. So now, do you see what is happening here? If you were just to take your income statement, you would see a profit number and you'd think, wow, I'm making a profit. This is wonderful. But now you go and take this tool out of your toolbox, the net profit margin ratio, and you apply it. And then you realize, I'm making a profit, but actually my costs are too high. Now, how will you know? You're going to ask me, how will you know from the result of the ratio whether it's too high or not? With each ratio, there's a general indicator that if you get if you get a result of 2, or if you get a result of 1, then it's okay. If you go below, then you should be worried. If you go too far above, it means something else. So with the ratios come their explanations and the guidelines in terms of what the results mean. So I want you to know once more, you're not learning this by heart. You're not memorizing it. It is a tool that exists and it will serve you because you understand it. Return on assets, it lets you know how well your assets are performing in terms of earning for the business. Thank you, Caroline. Now we go to liquidity ratios. We saw on the wheel that cash is king. You can pay your debts if you have cash. You can manage your business well if you have cash. So liquidity ratios show you how much cash you have. But in this instance, it's to tell you how quickly you can settle your debt. I've just put this note there. Cash control is key in running your business because your business can fail if you don't control your cash well. I'm sure we all know that. Poor cash control can lead to business failure. So liquidity ratios, here is the current ratio. I explained that to you at the beginning. It shows if the company's assets are sufficient to enable it to pay its current liabilities as they fall due. Here's another ratio. It's called a quick ratio, or it's called an acid test ratio. And it basically looks at current assets less your inventory divided by your current liabilities. It's taking the examination a step further in looking at your liquidity position. It's looking to see whether you can still pay your current liabilities if you deduct your inventory. In the travel industry, I don't know what might be your inventory. But in a production business, your inventory is goods that you have produced that you're waiting to sell. So I don't know what could qualify as inventory in the travel business, but this is a ratio that exists and this is what it means. You can add it to your toolbox. Thank you, Caroline. And then we have efficiency ratios, which indicate how well a company is utilizing its resources, its assets to generate income. I've got three types here for you. We've got inventory turnover, which shows how efficiently the business is controlling its inventory purchases and how well it sells. Again, this could be more appropriate for a production business as opposed to your businesses that are service-oriented. These are the two, your payable days and your receivable days. I believe that they're important for you. Payable days, it's basically measuring the number of days that a business takes to pay its suppliers. If your payable days are increasing, it shows that payments are becoming slower. When it comes to your suppliers, if your payments are slowing down, it's not necessarily a bad thing. It means your money is going out slower. But then, of course, it depends on your agreements, your agreements and your terms that you have with your suppliers. Receivable days. Receivable days shows how long it takes to clear your accounts receivable. The monies that are owed to you from sales on credit. Credit is sales that you made on credit. So the customers are still owing you. The receivable days ratio shows you how long it takes you to clear those accounts, how many days it takes you to collect your outstanding invoices. If you calculate your receivable days and it's getting longer and longer, then you know that it's taking you longer and longer to receive money that is due to you. And that's a danger. So there are lots of other ratios that exist. These are some of them. We're going to look at gearing ratios next. Thank you, Caroline. Right, so gearing is the extent to which a company is financed by lenders, outside lenders, as opposed to the shareholders. Your debt to equity ratio, it shows you how dependent a company is on debt as opposed to the company, as opposed to the owner's equity. It shows you how much of the business is owned and how much is owed. Basically, if we take what this business has, how much of it do we owe and how much of it do we own? Your interest cover ratio, it shows you how easily the company can pay interest on outstanding debt. These are ratios that may be helpful to you because of the fact that some of you, or maybe many of you, need to pay in advance before you get payments from your customers. So you may have special arrangements with your bankers where they give you advances and then you pay back. So some of these ratios can help you to be able to see how you stand in terms of being able to pay back. Thank you, Caroline. So still on financial management and decision-making, we're going to look at planning. And I hope we're all still feeling sunny. Thank you, Caroline. So what is planning? Planning is basically setting goals and objectives for the business in the short, medium, and long term, and also deciding how those goals and objectives will be achieved. So financial management also helps us to be able to plan. Thank you, Caroline. So basically, with planning, we're setting goals for every part of the business and deciding how we will allocate our financial resources to make those goals happen. So in my ticketing, in my tours, in my car hire, in my marketing, in the different sections of my business, I'm going to set goals for every section, and I'm going to see how I must allocate the resources to each of those sections to enable them to meet their goals. Good planning is facilitated if you have access to timely financial information, appropriate and reliable financial information. So it must be on time, it must be of the right kind, and it must be reliable, so it must be correct. Planning is also assisted by being able to analyze financial information. So we've just looked, for instance, at some analytical tools. We looked at trends, we looked at ratios. Being able to apply some of those to your basic financial information enables you to analyze, see where the business is going in particular areas, and that also assists your planning. Good planning is also supported by periodic business health checks to identify and solve problems before they become too big. What do I mean by business health checks? The same analytical tools that we have looked at, your trend analysis, your ratio analysis, you can apply them to numbers in your financial statements, in your income statement, in your balance sheet. You apply those analytical tools, and immediately you're seeing, what are our sales doing? Are we doing well in sales? Are we not doing well in sales? Basically, like a doctor, you're doing a health check and you're diagnosing, so you're finding out sales are going down. Sales are not what we targeted, what we had envisaged, what we had planned. Something needs to be done. So this is all part of the planning process. You do those health checks, and then you can come in with measures to rectify the situation before things get too bad. Thank you, Caroline. Right, so I'm tired of the word tools, so I'm using the word aids. Financial planning aids, which are basically tools. So we're looking at planning. What are some of the things that we use in planning and that help us in our planning? Budgeting helps us in planning. I'm sure we all know the word budgeting and budgets. Budgets help us in our planning. Being able to forecast, look ahead, helps us in our planning. Being able to carry out business health checks helps us in our planning. Key performance indicators also help us in our planning. Key performance indicators, we will look at all these in a bit more depth. Thank you, Caroline. So basically, financial management, it improves our overall business management, makes us more effective, and makes our business performance better. And these are some of the ways. Planning, better planning. We can plan better by using budgets. A budget is a financial statement, another kind of financial statement. It projects the business's activities into the future for a specific period. So for instance, you could have a budgeted profit and loss. You can have a budgeted balance sheet and so on. Basically, you're projecting sales, profits, cash flow, different indicators of activity into the future with the budget. And the purpose of the budget is to enable you to set goals and targets for the business or the different sections of the business. Remember, we mentioned that planning allows you to set business goals and objectives in the short, medium, and long term. So a budget is one of the tools that allows you to do that in your planning. And then budgets also enable you to control and monitor your business performance. When you have set those goals in your budget, you can go back and now monitor. How are we doing in comparison to the budget? Are we moving in the direction the budget said? Departments are working to certain targets. Are the departments working well in terms of those targets? So it's a control tool, it's a monitoring tool as well. Thank you, Caroline. And then forecasting. Another tool that was mentioned in that wheel, forecasting helps your planning. Forecasting also looks into the future, and it's similar to the budget, but it's more short term, if I can say. So for instance, if your budget is for the next year, you may forecast from 1 month to the next to say, within the budget, we are forecasting to do this much activity next month. And then you're able to compare how this month is going compared to what you're forecasting. So it's closer to actual performance, and it helps you to assess in the short term how you're doing. So it helps to assess if the budget is on target to be reached or whether remedial action needs to be taken. And it allows potential problems to be identified before they become too big. Thank you, Caroline. Business health checks, taking your business to the doctor. You're checking the business performance against planned milestones on a periodic basis. Business health checks, it can be by, again, applying some of those analytical tools we mentioned. You could go and do some ratios on particular items to see how it's doing. And if it's not heading in the right direction, you know that you need to come up with corrective action. You can do a trend analysis, look at how a particular item is performing over time. And then if you see the direction in which it's going, you know corrective action needs to be taken. Thank you, Caroline. Key performance indicators, we've all heard of them, KPIs. KPIs come in different shapes and forms. And basically KPIs are designed depending on what it is that we are looking to check. So KPIs evaluate business performance against business goals. They help you to assess progress quickly, and appropriately designed KPIs will help you to improve business performance. Again, the toolbox, your ratios, your trend analysis can be included in your KPIs for financial management. They can be applied to your cash flow, profit and loss. They can be basically applied to the different financial statements to see where you're going. So all the tools that we talked about, they all flow through financial management and help it. Thank you, Caroline. Right, so basically that in a nutshell is an introduction to financial management. Thank you, Caroline. So we have looked at different tools that we can add to our toolkit. It's like a toolbox. We have toolboxes. I love toolboxes. I always have one. Not because I necessarily know how to use them, because I know they are useful and I know how to use a few. And when I need them, they are there. I go into it, I take out the screwdriver, the size of screwdriver that I need, one with a cross, one with a, there are different ones, depending on your need. You take it out and you use it. It's exactly the same thing here. We are adding onto our financial management toolbox. And I'm saying, let's take what we already know and take it to the next level. We do financial management. We have financial management skills. Have I run out of time? Hello?
No, I think it's just my laptop.
Okay.
Give me 1 second.
It's the last but one slide.
Yeah. This one?
Yes, this one. Thank you. Yes, so we all do financial management to some extent. You all have an eye on the finances of your business. So all I'm saying is let's learn a few extra things to take it to the next level. We can get even more value out of the finances that are produced for us. Let's learn to understand a few key financial statements, your income statement, your balance sheet, your cash flow statement, and then the tools to interpret them, give us insights into how our businesses are performing. As we apply all of these skills, we'll be able to manage our businesses better, and they will perform better. Knowing financial management skills also helps us to get more value out of our accountants. And remember, don't go and fire your accountant because you've done a course on financial management. However, you're going to be able to speak more fluently with your accountant and tell him what to produce for you. Tell him that you want to see the cash flows. Tell him that you want information on this particular aspect, on that particular aspect. Or when he brings you the financial statements, you know what tools to apply. You know, you can do it with him, you can do it independently of him, you can work together. Basically, you're going to be able to work more productively with your accountant. So thank you very much. That was basically financial management part 1. And in part 2, we will go into more depth. Thank you.
Thank you so much, Dr. Boateng. Now we can open up the session for question and answers. So if anyone whose microphone is working, you can just unmute yourself and ask a question directly. For those whose microphones are not working, please just use the chat option and then we can read out your questions. This is a great time to ask any questions that you found challenging as you've been doing any financial management for your business, either this year or even in the past few years. So it's good to ask your questions now to the expert we have available and then have your questions answered.
So I hope that the sunny slides helped. Please feel welcome to ask questions. We can all learn from one another. Does anybody relate to any of the things that I talked about? Does anybody want to ask a question related to something that you've noticed in your business that I may have touched on?
Hi, I have a question.
Yes.
Could you kindly explain the term technical insolvency?
Technical insolvency.
Yes.
Okay, I don't know it off the top of my head. I do know that insolvency means that you're not able to pay. You're not able to pay your debts. So technical insolvency, it must be linked to that, but I don't know what the specific term means.
So when a business is allowed to declare technical insolvency, yes, with regard to its finances, that is not the same as bankruptcy?
There seem to be so many nuances. There seem to be so many nuances when it comes to bankruptcy. What do they call it? Business rescue. There seems to be so many different nuances. So this must be another one of them.
Okay, thank you.
I'm going to quickly look and see what it says here. It says technical bankruptcy often refers to a state in which a debtor has defaulted on a debt and would likely qualify for bankruptcy protection, but has yet to formally file for protection in a bankruptcy court. So it sounds to me as if it basically means there's bankruptcy has happened, but you can take a step to prevent being declared bankrupt. So you're in a space where there's a gap before being declared bankrupt, and you can go and file for protection.
I see. I came across the term when dealing with suppliers who were holding deposits and cannot now refund the deposits on account of COVID.
Because they've gone bankrupt, because they are being declared technically bankrupt.
Yes, which means you can't sue them, you can't, do any litigation.
Wow, okay. So that's where the protection comes in. They are basically protected
Yes.
from being touched.
Yes.
Okay. Oh, I'm so sorry. Is this is your personal experience?
Yes, it is a personal experience. But let's say we had an angel investor who came in and rescued the supplier.
Mm-hmm. You're asking what would happen?
In good time. Yeah.
Okay, so the situation was remedied. Okay, I don't, are you okay with that question?
Yes, yes. Thank you so much. Thank you.
Thank you. Any other questions?
Thank you, Elizabeth. I also saw Caroline Karanja's microphone go unmute. So Caroline, if you'd like to ask your question. Hi, Caroline.
I'm seeing a question here from Francisca. She says, what about when the company goes into receivership? So I assume that she is asking, Francisca, I assume you're asking what is receivership?
Francisca, if you'd like to unmute your mic to elaborate more on your question, please feel free.
Okay, so basically receivership, again, it's in that space, bankruptcy, receivership, basically, and I'm going to read what the definition seems to be. It says a situation in which an institution or enterprise is placed in the hands of somebody who has a custodial responsibility for the property of others. So I know that when a business goes into receivership, for instance, there are certain categories of shares. So the owners of the business or the people who are owed by the business, certain categories of debt. There are certain repayments of debt are divided into categories. So certain types of debt, certain types of debt get preference or priority over others. So the receivers decide who to pay first. They first of all try and retrieve all the money that they can that is owed to the business, or they try and sell off assets and so on in order to be able to pay off the debts of the business. And I think that that's what this is about. I hope that answered your question, Francisca. I'm not an expert in business failure, bankruptcy, and so on, but it's happened often enough in the news. My favorite airline, SAA, is a a victim of all of these things. Right.
Are there any more questions for Dr. Boateng? Okay, maybe I have one. So, Dr. Boateng, you went through so many tools, and maybe some companies already have their accountants with them who understand all this, but is there an easier way to calculate all the ratios and all the tools in one place?
You're asking if there's an easier way to calculate them?
Yes, or like since there's so many different tools to use to calculate different things,
Yes.
is there, for instance, maybe not an app or
Find them.
yes.
Yes. They're on the internet. They're everywhere. Your accountant will know them. Your accountant will know them, but they're on the internet. So what I do, for instance, with the ladies, the business owners that I've been coaching, for some of them, when the question arises or when we talk about it, if they're interested, I basically provide them with a list of ratios with what they are for, so that they have it somewhere. I find that that's the most useful approach, because you can't learn them all, you can't learn them all. You may not even want to learn any if you can, if you know where to go and get them and you know how to use them, So it's good to have them in a handy place. Maybe what I can do is reproduce a list that I attach to the slides in the next one. Or Caroline, would you like me to send you a list?
Yes, that'll be very helpful. And then I can send it together with the presentation slides and the recording.
Okay, I'll do that.
Okay, so this is going to be the last part for question and answers. So speak now or forever hold your peace. And then we can conclude the training. Okay, so it seems we have no more questions for the moment. So we're going to be concluding the training now. I will stop the recording. As I mentioned earlier, I will